Ooh, things are not looking pretty for Alibaba Group. Down 8% today after already being down in the past month by 32%. Year to date, down 50%. And if you're looking at the max chart, they're only up 19% all time since they listed on the New York Stock Exchange in 2014. They were at about $93. Wouldn't be surprised if we go under $100 sometime before the new year. At its peak, this stock was $309. What a precipitous fall of 63% since then. One of China's biggest e-commerce player. Oftentimes, Alibaba is likened to the Amazon of China. I am an investor of this stock. I have not sold any of my Chinese shares yet, and I don't plan on doing so, but like, oh my gosh, it's so painful to watch this stock, as well as DiDi. I'm not invested in DiDi, but this stock is down 16% after actually confirming that it will delist from the New York Stock Exchange. Baidu is also hurting today, down 8%. Over the past 5 years, it's down by 20%. Its max chart, it's still up by 1,000%, but like, wow, what a fall from, again, $300 down to $135 right now. So let's talk about what's happening in China, what I'm doing with my shares. So welcome back to another video. I'd appreciate if you give this video a like and subscribe if you enjoy the content. But yeah, so basically, China's shares that are listed in New York have been getting absolutely decimated after concerns. Well, first, DiDi went public against Beijing sentiment, and there was a cybersecurity probe launched against DiDi, and following that, basically, I think mainly to punish DiDi, they launched that probe, they fined DiDi, and I mean, a little bit like more than like literally less than a month later, they announced that they're going to delist from the New York Stock Exchange after basically they're not allowed to share their auditing information, which is now required and was passed by the SEC. So we're going to be talking about all of that. So basically what you have to know first of all is last year a bill came out, or a bill was being proposed that will force Chinese firms to meet US accounting standards, and that passed Congress. And it was finally signed and it went into effect basically this past week. And basically measures taking a harder line on Chinese business and trade practices generally pass Congress with large margins just because it has support from both Democrats and Republicans. So, oh man, and usually companies like Alibaba, Baidu, their accounting practices are pretty standard and pretty open for the SEC to kind of go over. But something like DiDi had no history of basically getting audited, no accounting practices that pass the standards of US accounting practices. And so, I mean, obviously they're going to delist especially since DiDi is a new firm, they're a cybersecurity threat, apparently. That's what China calls them. And then on top of that, now they're not meeting accounting practices. So we have to understand is that Alibaba has been on the US stock exchange for a number of years. DiDi just became public. And because they're not meeting those accounting practices, that's why they're getting delisted off of the stock exchange. And I think it's also partly China trying to set an example out of DiDi, right? Being like, okay, if you mess with us, I mean, they went public against their will, and basically like, okay, well, if you go against our will, we're going to destroy you. And I mean, look what happened to DiDi stock for their max chart. It's down by, again, 60%. It started out at, $15. Now it's a $6 chuck. And this is hurting all the stocks. And basically, there's like the spillover effect. So because one Chinese stock is hurting, that also means that other Chinese stocks are also hurting, and this is seen with Alibaba, right? So, I mean, now people are thinking, well, is Alibaba going to be delisted? I mean, over the past month, it's down 32%, past 1 year, down 57%, past 5 years, it's only up 20% for such a growth beast. You have to understand this company is hugely profitable. It's literally the Amazon of China with faster growth rate than Amazon. And again, I'm optimistic. I don't think that Alibaba will necessarily get delisted. I think tensions would have to rise to new heights, but you never know. You look at investors such as Ray Dalio, He has quite a bit, about 1.25 billion for his third fund in the country in China, and he's a long time China bull, right? So I mean, you have to take that into consideration, that there are certain people like Charlie Munger, Ray Dalio, that are long time bulls of China. They're just pouring more money in, and I mean, the consequences of Alibaba getting delisted is that honestly, retail investors might get screwed because they might not be able to actually transfer their shares to the Hong Kong exchange equivalent, because that's basically what DiDi is going to do. Is DiDi is going to be listed on the Hong Kong exchange, now only on the Hong Kong exchange, not on the New York Stock Exchange, and depending on what platform you're with. So, for example, Wealthsimple, they don't really have anything that allows them to allows investors like me to basically own Hong Kong listed shares, right? But institutional investors may be better off. They may be just able to switch their shares. So basically what would happen is that I think that if a stock gets delisted, basically you would have to liquidate your shares, and basically have that as a loss, which would really, really suck. And that's something that I'm hoping will not happen. And I do not think that will happen lately. But let's just take a look at like one more article here. DiDi's global U.S. listing will surely go down as one of the most ill-fated in history. It plans to delist from the New York Stock Exchange and prepare for a listing in Hong Kong. It was only 5 months ago that the company raised $4.4 billion in a U.S. IPO. Yeah, aside from being an unmitigated disaster, the tale of woe has wider implications. So the situation has escalated at a fairly rapid pace in recent days, so the SEC moved to complete plans Thursday to require foreign companies listed in the US to fully open up their books to inspection, which is like auditing, which is basically this bill, which was basically Wednesday, December 2 of last year. So, only took a year. Today's Friday, December 3rd. Oh, SEC chair have historically not played ball. Chinese companies could be delisted if U.S. authorities aren't allowed access to audits for 3 consecutive years. Again, right now, Alibaba is following the rules. Okay, it's just DiDi is not following the auditing guidelines because there's a probe against them from China, and China is not allowing them to basically open their books to the U.S. There's also more pressure coming from Chinese regulators, who are reportedly planning to ban companies going public on foreign exchanges through the controversial variable interest entity structure. And that doesn't mean that existing companies like Alibaba are going to be delisted. That just means that more companies or newer companies are not going to be able to allowed to be listed on the New York Stock Exchange. Either way, tensions between the two world's largest economies on this particular issue are clearly worsening. Investors in popular U.S. listed Chinese companies have had plenty of warnings, but the endgame now may be closer than ever. That's true. If Baba gets delisted, we're all just absolutely screwed, okay? Like, I will go down in history, and this will be like my worst investment ever. However, if tensions somehow ease and Alibaba and the like Baidu are allowed to stay on, we could see a massive, massive gain in Alibaba stock and in other stocks. Okay, so you're looking at the past 1 year, okay, past 5 years. I mean, every time this has gone from a $200 stock to below or to like 130 whatever dollars, that's down by 35%. Okay, we've seen a massive increase or decrease by 63%. Just in the past year. So, you could potentially go from, this goes to $100, you could triple the value of your investment if you bought at $100 and it goes back to its highs of $307, right? So without risk, there can't be any reward, or not as large a reward. But I mean, I think that Alibaba, my take is that Alibaba is trying to play nice with Chinese and US regulators, or trying to comply with both, and they will not get delisted. China already axed the IPO of Ant Group, and I think that this will be the last step, hopefully, before there is a rebound. Okay, I think that this tremendous this is like, we're talking about billions of dollars. So this is a $305 billion company, despite this 63% drop. Okay, so this was a company over $700 billion at its peak. So you're wiping off like $350 billion off of the market cap of some large Chinese companies. Soon the bleeding has to end. And I think that, if you just double down in your positions like Charlie Munger is doing, you will get rewarded in the end, because this is starting to look like a clear value play. P ratio of 15. Okay, like, that's just absolutely ridiculous. So All I'm saying is buy the dip. Let me know what you think. Love you all. Take care. Cheers. And thanks for sticking with me this far. See you in the next one.